Let's get across the market open. Scott Phillips joining us from the Motley Fool. Scott, welcome to Friday. Good to have you back on the show. Now, a fascinating week, isn't it? Particularly with a focus on resources, given the movement we've seen in the gold price, and also, of course, that White House deal on rare earths.
Huge week, Andrew. G'day. I tell you what, some weeks go quickly, some weeks feel like a year. Doesn't Monday's meeting feel like a lifetime ago? And yet, it was only earlier this week that Donald Trump and Anthony Albanese agreed on a rare earth deal, $8.5 billion being sunk into it. We saw, of course, massive movements in share prices. Interestingly enough, Linus fell while the others rose. Some element of buy the rumour, sell the fact, I dare say. But also just the reality of what this kind of means strategically. And that was a huge deal for those particular miners. A really, really good meeting, frankly. I mean, look, I don't love government subsidies for anything, let alone rare earths miners, but in geopolitical sense, if you walk out of a meeting with Donald Trump smiling without any sustaining any damage, then you're in a pretty good place, and that was the result. So overall, good for the country, good for the economy. We avoided increase in tariffs. We avoided any issues around pharmaceuticals or social media. Any of those could have been meaningful flashpoints if Trump was in a worse mood or had a different agenda or objective. So that was a good result for the country overall. And the rare earth deal, good for those miners. It does give them some degree of certainty. We haven't seen all the detail just yet. One-page press releases from both the Prime Minister and the President mean that lots to be worked out, or at least maybe it's worked out, haven't been told about it yet. So that's going to happen over the next little while, I suspect. But good news for our rare earth miners in general, possibly as much as processing too, and some work on some money for a port. So that should be a bit of a fillip for those industries and those commodities where there's kind of been a bit of uncertainty. The flip side of that, of course, was a couple of days later, China came out and pretty much accused us of being a trading bloc, allusions to war, obviously very well chosen, deliberately chosen by China to make their point. And that's no small risk. Well, we focus on the good stuff and the rare earths, and that's absolutely fair. We know China's our major trading partner, and iron ore really is the key commodity here, not those rare earths. So we hope that doesn't get worse. That was always going to be the risk, and the government knew that. They had to make a decision and take a position. They've done that. They can say it's all about mind in Australia and all those kind of wonderful slogans and buzzwords, but we do have to watch the Chinese response. Tariffs and effective trade bans on wine, seafood, barley, not that long ago, right? Still fresh in the memory. So where and when that happens, if it does, is something we need to keep an eye on. And then you're right, we talk about gold and the run of the gold price. And then a little bit of jitters midweek. That is an extraordinary story if you see what's happening with the gold price over the last year, 2 years, 3 years, 5 years. That up and to the right, almost vertical at some point recently, does make you think there might be some concerns, some risk. And we saw the price fall the largest in a dozen years or so during the week for exactly that reason. I got to say, I'm not going to be particularly jumping into gold anytime soon. Not because it can't go higher or won't go higher, but when a precious metal that's supposedly a store of value jumps 55% in less than a year, it tells you everything about how people are thinking, the fact that it's sentiment driven. Now, there are a few circumstances in which gold can justify that sort of gain, but they kind of come down to kind of economic collapse levels, because realistically, the change in the circumstance of the US economy, the US government between January and now, it's not worthy of a 60% rise in the price of gold, right? There's not that much more money being printed. The chance of economic collapse is not that much higher. If it is too, I wonder who you're going to sell your gold to if everything else is gone to rubble around you. But look, the sentiment is pretty strong. It is clearly a sentiment-driven decision here. Maybe a weight of money coming out of bonds and fixed interest going into gold. But again, at some point, that can in the short term push the price higher. Doesn't justify the fundamental value that underpins it, particularly compared to the cost of mining. So there's lots to be said and done in the gold space. But save you asking the question, no, I'm not buying gold. No, I don't own any. If I did, I'd probably be selling it, I've got to say.
Even the gold miners you'd be selling at this point, would you?
Yeah, well, here's the thing. I mean, the gold miners are actually riskier on both sides of that ledger than gold itself, right? Because they're leveraged plays. So if you think about the way this plays out, if the gold price rises, they'll do much better than gold. Why? Because they're fixed. The costs are fixed. The volumes are not overly easily changeable, and yet if you get a much higher price, you simply get a higher leverage. You get more revenue, the same costs, and so proportionally your profit increases faster because of the operational leverage than your revenues. And so they will or should see a leveraged gain against the gold price. The problem is on the flip side, if you do see the gold price stutter and fall, the same should also be true. You've got the same fixed costs, you've got the same volume, so the same variable costs largely, and you're getting less for your product. Again, that reduction in revenue goes straight through to the bottom line and has an outsized impact on the bottom line, on profit. So, if you worry about gold as a commodity, you probably should be doubly worried about the miners. If you can find one that's particularly well priced, or the market's left behind, I guess there's a chance. But it would be a remarkable situation if we didn't see larger falls in miner share prices than the commodity itself over the fullness of time. Again, a day, a week, a month, anything can move. Sentiment's a funny thing. But the maths of it should be, if they are being priced rationally, by the way, if they're not, that's its own warning, but if they are being priced rationally, you should see that the mining share prices fall faster, because profits will fall faster than the price itself.
Scott, just to clarify, you obviously began with the rare earth miners. What would you be doing with those then?
Yeah, that's a really big one. We don't have enough detail. And so I don't know any rare earth miners, to be clear. If we get genuine commitment on a floor price, that's the maths you've got to start doing about where and when they're going to make money. Because if you can justify the volume and you know the price, I mean, we just talked about gold, you can't know the price, or if the price moves, you're in trouble. If you can bank on an effective or a literal floor price, then you know what your downside risk looks like. As long as they can get out of the ground and get it, mined and processed commercially at a given price, you're in a pretty good place, or at least you know what the downside is. And so that does kind of take some of the risk out of the story, really, frankly. Now, again, I haven't seen yet, I don't think anyone's seen the exact numbers of what that will look like. And of course, when you say rare earths, there's 30 or 40 key minerals here, so it's not just a single price for a single commodity. But if you do end up with that sort of situation where you can rely on a floor, then it does mean you should reevaluate what's going on. And then the maths is a lot easier, because you've got limited downside, I won't say unlimited upside, but potentially more upside if and when things change. The real watch out for me is still China, because for all of that, while the floor might be a floor, it also might be an effective ceiling, because you're not going to get much more than that unless and until China ends up selling for higher prices as well. So you've almost got, okay, I won't call it a fixed price because that can be taken out of context or misunderstood, but you may have a floor price which ends up being a maximum as well, just because of the market dynamic. And then there's a very clear maths question of simply, what does it cost? What are you selling for? Multiply that by the volume. Again, these things aren't perfectly forecastable, but the range of outcomes changes dramatically. I would be sitting on the sidelines, but if and when you see some opportunity there, it's probably going to come down to operational excellence and volume if you know the price is relatively stable.
All right. Scott, just before we move away from resources, we're in quarterlies, of course, at the moment. PLS out this morning.
And this is exactly what we were just talking about, right? So you look at their volume, 2% growth. And I'm deliberately not leading with the headline here, because their revenue growth was 30%. And what's the difference? Of course, it's price. I mean, we know that, particularly lithium investors and Pilbara investors in particular know that. But that's the story of this quarter. It is simply a case of volumes were stable, up a little bit, pretty good result for volumes. The value was up much higher because lithium price was simply higher than it was this time a year ago. And that's a win. You take it every time. But that's exactly the story we just talked about with gold and with the rare earths miners. You can't control your price, you can only control your volume. So that was a really, really good result. Again, though, we're looking backwards, so it's a challenge. The volume growth, I think, was probably decent. The real challenge for lithium is not really volume. It's not really a volume story. It's going to be a price story. But yeah, a good result for Pilbara. Did exactly as much as expected. You do exactly what you want. You take the price when you can get it. You just brace for it when things go the other way.
All right, and let's just round it off with a look at Zip. It had a quarterly update a couple of days ago, and news that just struck a deal too.
This deal is potentially pretty big too. I'm not a Zip shareholder, but they did deal with Stripe. Now, Stripe is a payments processor. They're an amazing business, by the way, and used right across the economy in heaps of different ways, different places. So you won't necessarily see it if you're not familiar with the payments processing network. You won't necessarily see Stripe ever, maybe, or you might see powered by Stripe at the bottom of a website somewhere. But they provide the payments engines for heaps of online retail. And Zip has done a deal with Stripe to make Zip available inside the Stripe ecosystem as effectively just a toggle on and off option for retailers. And so why this is huge is a retailer simply has to say, yes, I would like to use Zip through Stripe. They can just turn it on with the flick of a switch and the whole thing comes to life. And that is fantastic news for Zip, because it really does open up. When you get someone else to do the marketing for you, you become a feature of someone else's product. That's damaging or dangerous if they don't grow the product. If Stripe was to fail, Zip has no control over that. They can't get around any sort of reduction in growth or failure or something else. On the other side, if you simply can all of a sudden open yourself up to an entire network of current customers, plus I suspect Stripe's got a lot of growth left in it, so Zip gets to really draft on that Stripe growth for potentially a long time to come. The big bit, as I said, is just simply turning it on now if you're already using Stripe, and then whatever Stripe manages to grow at from here. So really, really good news for Zip. Obviously, the consumer element is still a key part of it, but if you have a Zip account, if you want to use Zip, and you couldn't previously through some of those e-commerce retailers. You now can or will be able to very soon. So yeah, really, really big news for Zip long term. As I said, sugar hit up front, but the long term growth that provides drafting Stripe's own growth, really, really good for shareholders.